So if you look at it that way, if you look at it that way, it means you're going to reach a Gaussian at lower kappa. Okay, and how do you reach that under summation?
Yeah.
Is obvious here that of course a larger sum is going to be closer to the Gaussian, but look how slow it gets there. And we think, as Marcus has discussed, that we will never get there.
Okay. So I can try to show my replication attempt, and this is one where if people are interested or can share a better version, that would be really cool. So I've got like mean deviation. It's just like the mean of the deviations, of the absolute deviations. Then I'm calculating kappa, where it's basically the formula we had in the book. And this is where I struggle because I'm doing something wrong. It just looks like a mess. So I'm going to need to look at this afterwards. But I tried then to do the bootstrapping kappa, which is basically you basically repeat the kappa test by random sampling, because when you're doing the kappa estimation, how to describe? One second. When you're doing the kappa calculation, you're grouping the data into windows. So basically the bootstrapping, as I understand it, is that you group different data points together. So if you repeatedly do it, each time you're grouping different data points together, and that's your bootstrap. And if you take the mean, you get a smoother view of how that behaves. So it's not very nice here, but yeah, this will be a bit of a messy plot, but I'm trying to go for what we have in the book, which is like this, and what's more like what Marcus was showing in the previous session. So I might pass it on to you there, James, and I'll be back with the machine learning part.
Okay, just one comment. The kappa cannot be negative. No, Marcos? In sample, kappa cannot be, even in sample, cannot be negative.
Yeah.
Okay.
That's a good check that I'm going wrong.
Great. Yeah. So thanks.
Yeah. So yeah, it shouldn't pop down there. I think I'll just look at the mean deviation behavior and then work it out from there. So yeah, James, if you want to take over.
Yeah, for sure. So picking up from next page, so test 2, it's on the next page, I think. So so yeah, carrying on from Fergal's discussion there. So kind of looking at the next section. So test 2, and yeah, I've also done some stuff in R. So kind of tried to do some of the pieces that Fergal had been looking at there, but I actually felt a little bit old there looking at Fergal's stuff. I look much more slick than what I've done. But yeah, so this piece, so I just put this one slide showing where I got the data from, but I took it from the Wall Street Journal, so daily returns, and I also looked at log returns, simple returns, in the same way Fergal had. Log returns, they have like a domain of minus infinity to plus infinity. Simple returns, it's kind of minus 100% to plus infinity. So sometimes it's better to look at the log returns. You get kind of better look at the respective tails. But let me just go through test 2. Yeah, so the first one, definition 10.1. This is basically the expectation above a certain point. And it's done in the book. We've got that, again, as Fergal talks about, we've got that for negative and positive returns. So these two values here, I've kind of tried to replicate in R. So my endeavour to do that in R, I've just got these returns that I took from the Wall Street Journal. So I'll just quickly run this, as you can see a little bit, just what I've done there. So I've got a histogram of the daily returns. So I think these are the log returns, but you can see there's kind of just this enormous bottom point here, that 1987 point that Fergal mentioned there, and there's kind of a spike at the 10% as well, and that comes through in the kind of daily returns as well. You can see like one after the other sequentially. So that should come through here. Yeah, so you can see this. I think this is in one of Nassim's books, but it has this kind of clustering around the various periods as well. So you've got the 1987 big fall there, and various clustering at other spikes over the time horizons. That comes in later in one of the other tests around independence of the maximum and minimum. So yeah, we just got the negative returns and positive returns. We kind of calculate those, and this first test. So yeah, the first test we're basically trying to work out as k gets bigger, that this ratio here. So if it's not a power law, then this kind of test 2 should go to 0 as k gets bigger. And it should go to a kind of stable value as otherwise. So that's kind of tested in the book. So I think you can see some kind of plots so going down, yeah, which is the one with let me just check which number it is. 10.4. Yes, I think 10.4 shows it's basically not reaching 0. So yeah, okay, this plot, yeah, it's a nice plot of that. It's just basically, it's nowhere near reaching 0. So this test, so I had less data points. I don't think I had only the last 5,000 daily returns, and I just plotted them. Yeah, I plotted them every 1% rather than, so it's kind of not approaching 0, which I was hoping is right. The negative and the positive ones. So yeah, that test seems pretty clear, that this S&P is kind of not approaching 0. But I think this calculation has got very fine points for K, whereas I had one every kind of percent, so a bit less jagged. Mine were. Test 3. So this is on the 4th moment. So this kurtosis, and looking at taking out a single data point and what effect does that have on the kurtosis. And there's a kind of commentary here around other time series like gold, oil, silver, and so forth. So I kind of tested that as well, taking the kurtosis of the log returns. So that's 29. So Fergal mentioned there that for a normal distribution, that's 3. For the S&P daily returns, it is 29. Then if we take a kind of cut of that data, we just remove that, so the worst data point. It's a log return, so minus 22.8%. That's the worst return. So if we remove that from the data set, so it's exactly the same data set, 5,000 odd data points, and then we just kind of remove that point. So this cut data, it's exactly the same data. If we do, if we just do that plot again, so you can see, it's exactly the same, but with just 1 point removed. That works. Yeah, okay, so it's exactly the same data without that 22. And then we calculate the kurtosis of that. So it comes out as 14. So it's been cut in half just by removing one data point. So that's test 3. So you can clearly see most of the kurtosis depends on that single day of data. Test 4 is what's called this MS plot. So this is a it's kind of a maximum to sum. So it's this kind of ratio of the maximum in the data to the sum of the data. And for a sequence x1 to xn, you take this ratio where the maximum is kind of the maximum of the data you've got so far, and s to the p is the sum of the data you got so far. So that yeah, so you can basically measure that. That's our test for. So it's another test we basically do on the S&P data, and kind of coded that up here as well, I think. Yep. So this should be working out test 4, and this, let me just double check what this should be doing. So it's going to 0 as n tends to infinity. Okay, let me just see what we found around that. Okay, right. So that's the thing. Yeah. So it's not going to 0. So it's kind of going from left to right. Sorry, from right to left as you get more data. So there's more data points on this side in this plot. So we've kind of done that test really, that it's not going to 0. So figure 10.3, I think, is in the book on this. Let me just pull that one up. 10.4, 10.3. Oh yeah, okay. So yeah, so this MS plot, it's kind of similar to me. I think there was just more data in this than what I had, but so I only had the last 5,000 or so out of 15,000. But there's this clear change at that 1987 point when that piece is included. Yeah, so these are basically just a kind of collection of diagnostic checks on the S&P index. Can be applied to any kind of time series, and the idea is to check some of these sort of assumptions around the probability distribution that might be most appropriate for this data. You can see there's a nice plot, I think a QQ plot on the next page. Yeah, okay, so this one here, 10.14, shows a nice QQ plot for comparing to a student T. I think that has like 3 degrees of freedom. So I think that doesn't have infinite moments, but the downside tail, just make that a bit bigger perhaps. Yeah, the downside tail is a pretty good fit. The upside tail, I think the data is probably thinner tailed on the upside, but it's probably a good fit on the downside, I think. So if that QQ plot, if the data is along the line, then it's a good fit for the distribution you're comparing to. So student T, 3 degrees of freedom is good if you're looking at the downside, but probably less good if you're looking at the upside. So then there's another kind of test here, which is we call this Gumbel record method, and it's basically looking at the number of records you have in your data. So where your kind of current maximum is bigger than your existing data, or sorry, so the next data point is bigger than anything that happened in the past, and that's referenced to Embrecht's book, which is another excellent book on this similar topic. So this point here, then it's basically looking at this measure. So you take the maximum of the data you've got so far, and you count a 1 each time you've gone above that maximum. And the idea is that you're kind of you're checking, does this, so it should increase along this line that we see here, unless there is some dependence between the maximums. So that basically means if we have one spike above anything that's happened in the past, that's got some dependence on another spike that's but bigger than anything in the past, or similarly on the downside. So we've looked at kind of gains and losses in this plot, and you can see that the green, the losses aren't too far different from this kind of function. So that tends to indicate that the negatives, or the maximums to the downside, are more likely to be independent of one another, whereas the positive returns are more likely to be correlated with each other. So I think maybe you can say that if you've had one positive day, that you're more likely to get another one shortly after. so that's certainly based on that historic data. So
Yeah. Sorry. One comment, James, that from observation and this, noticed, people have noticed for years. So I'm not saying anything particularly intelligent, except that everybody discovers it. When markets are volatile in the S&P 500, they tend to be negative, and they bounce up and down. There's serial autocorrelation during negative moves. So, and if you look at the rallies, the rallies are slow and positively correlated. So it goes up slowly, you see, in correlated way. And you can see that even within a day because of VWAP and other execution techniques. But then when it goes down on negative days, when it's more volatile, it starts whipping. So big down move will be followed by big up move or semi-big up move. You see?
yeah, okay.
Sorry to interrupt, but I was just put some color.
Okay, that's helpful. Yeah. Okay. All right. So yeah. Okay. So but the down moves themselves are kind of independent of one another. So if you have like one big down move, it's not going to impact the next day as being a big down move. If I understood that correctly.
Yeah. Yes. A big down move are not followed by a big down move.
Yeah.
Okay. Up moves are followed by up moves.
Okay. Okay. All right. So that's really helpful. Okay. So
oh, that's what the data shows.
Yeah. Yeah. Okay. Then the next piece here, I think we had yeah. So what was the next piece? Okay. Let me shrink this a bit again. Yeah. Okay. So this is looking at some kind of sub blocks. If you're dividing the data into kind of sub periods and run a kind of similar analysis, the kind of up moves and the down moves again are shown there. And this, yeah, okay. So I think this is kind of another similar test to the previous one there. Yeah, okay. And that chapter then is basically summarizing what the S&P is, which is a lot of us are kind of looking at that. So from the insurance perspective, we are looking at it from like annual returns. But I think bankers are looking at it from like 10-day returns. But there is some kind of there is a large connection between all these different pieces. So the 10-day or the annual, you've got a kind of a nice there's something similar amongst them all. I guess that's what this chapter is saying. So you can get some good tests from this paper. And if you're working in a bank or an insurance company, that's really good in terms of showing you've got a good understanding of what this data is. There's some of the appendices now on chapter 10. So the first one, there's two. There's one on the problem with econometrics, and there's one on machine learning. So I'm going to talk through the first one on econometrics, and Fergal is going to talk through the second one on machine learning. But this one is basically kind of a bit of a critique really on econometrics and economics. A lot of the models used by in economics and econometrics are based on this kind of standard Gaussian assumption, and that's kind of, as the last chapter showed, that's kind of radically wrong. And this piece here is kind of looking at, it's not just the S&P, so some of the other indices and so on are clearly not Gaussian, and they never have been. So it's really a question of people finding nice models, but not doing these kind of tests that were in chapter 10. So never really understanding that those models aren't appropriate. But yeah, so there's this test here is how much of the ketosis is explained by one data point, and there's some kind of different indices shown on this page 201. So silver, S&P 500, crude oil, and so forth. The maximum contribution to the fourth moment of a single daily observation. They're all given on this in that table, so it kind of nicely shows that that just huge proportion is dependent on a single observation, which is what I showed there on that piece on the S&P. I think these might be non-central moments or so rather than the central moment, which is what I looked at, but so slightly different numbers than I had. But yeah, so basically the economics models you can't really use for any of these asset types or indices. You can do this analysis here looking at the kurtosis over non-overlapping periods. So if it were like just one kind of underlying probability distribution, then you wouldn't have that massive spike that's coming out there. You kind of expect to have something a bit more similar. So again, that's clearly highly the kind of variance of the variance is very high, as you can see from these plots. So and there's some kind of more some other plots here, basically kind of just demonstrating that these sort of general assumptions underlying economics and econometrics are generally wrong. There's something so that you can get these other models. So there's Garch and so on, which so that Garch type model kind of attempts really to address a lot of the issues that are raised in this appendix. So it does have the variance itself changes over time, so forth, and there's also this Poisson jump model. So I've seen these in there's some of the big providers of financial models. So they have these Poisson jump models, and they have the Garch model as well. So the Poisson jump model, the criticism here is that you can fit it to any data set, but it's basically the same as fitting a polynomial to n data points with n-1 parameters. So it's not really telling you anything, whereas having a kind of model is the general intent is that it's kind of giving you some vision of something that you could do usefully in the future, rather than just kind of fitting to the data. Yeah, and okay, and then the final point here is this sort of skin in the game point, that a lot of the if you don't kind of get burned by these models going wrong, then you don't really care. So, and a lot of the people who kind of come up with these models don't get burned. So yeah, those chapters are nice kind of slaying of the econometrics models, and yeah, just kind of showing that if you apply these tests from chapter 10 to all these different data sources which are described in economics and so forth, you kind of find that a lot of the underlying assumptions aren't quite right. And probably a lot of decisions based on those models may need to be revisited. So I think that's it for. So can I hand back to you, Fergal, for the machine learning piece?
Yeah, sounds good. 1 second. Yep. Can you see it, the screen okay?
Yeah.
Good. Yeah. I mean, in a way, I'd summarize this as like, with machine learning, you can sort of think of it in a fat-tailed way, or think of it sort of not considering fat tails, and you'll see how I describe that in a moment. So a lot of this is analogy with option trading. So I mean, let's jump to the picture. Like basically in options, you have, this would be a call option. So you can build different basically functions using your options by combining them. And this is all analogy to machine learning, where you might have, well, you might also have this, but instead it's like your prediction of something. It could be like a temperature sort of prediction or something random in machine learning, where you've got an input and you're trying to figure out your output estimate. So yeah, using the analogy with options, you can basically take call options and then do a weighted sum of them to get all sorts of payoffs of interest. And then in machine learning, you've got terms like neural networks or such, and typically in some machine learning, you'll find a step function basically, which is if the input is below this threshold, you've got 0, and above you've got 1. This is not really taking fat tails into account, because you've only got 0 and 1. You don't have minus infinity and plus infinity, and that can be a problem, especially if you train on a sample, but then reality is wider than your sample. The other thing is, this is a bit related to the next chapter, where it talks about binary options versus non-binary options. So this would be the binary option, and this can be a bit of a problem. So then we can start looking at sigmoids. So basically, if you smoothen this out, so it's not quite as rough, as like immediate, you get your sigmoid, which is just an S shape, and that's sometimes used in machine learning as well, because it can be more gradual. But you still have this problem with saturation. It's like it's sensitive to your input in a certain range, but what happens if your input is like way out of the range? You sort of haven't prepared for that, and there's no effect in your model for anything happening in the far ranges. And then taking this building blocks approach, where you've got the weighted sum of sigmoids, or the weighted sum of options. The remark here is about, let's see. Right. So if you want to build something, so if you want to use this S shape to build a function, and in reality, your function is like from 0 to infinity. So like the output is 0 way up to infinity, or from minus infinity to infinity. In theory, you could sort of use S shapes as a building block, but it's not very good, because you need an infinite number of S shapes to fit, to sort of stack them all together and get this function that goes towards infinity. And basically, you sort of need to split the S in two, so keep the option-like part instead of flattening it out again. So
may I make one comment that may
Yeah.
simplify? That in
Yeah.
the past, they only used sigmoids in the past.
Okay.
And then at some point, magically, they started using half of sigmoid.
Yeah.
Which is infinite on one side. And
Okay.
so when they did the sigmoid, it was not as performing. And when they started using half of sigmoid, which is all these functions that have this singularity at a strike price equivalent.
Cool. No, that's great.
Sorry, that was that was the motivation behind the chapter. Yeah.
Yeah.
Thanks. No, just a comment. Thanks.
It's like how machine learning learned.
Exactly.
And just for people who haven't done much with machine learning, if you dig into like a basics course, you'll basically, when you dig into the basics, you'll find these sigmoid functions popping up, and then it will start to make sense. Or the non-sigmoid functions that are like the ReLU function, which is the machine learning word basically for a call option or something similar. So you can express these functions in different ways. So here's one. Let's see, what shape is this? Right, so this function takes you from an infinite domain to an unbounded domain. And this is what we want. So you could just put that in your computer and see how it behaves for different parameters. This is just a reference about how you stack things together. So you could sort of create these functions and then sort of add them all together to get some combined payoff. And this is so basically with options, you've got the final price is this like hard kink, but the price before the option expires is actually a lot smoother. So that's like the difference between your binary and your S curve, or the difference between your call option and your call option before it expires. So that's how you can get smoothing. if you want behavior that's not a kink, like this ReLU function, it's just like an option that is like still has time before maturity. What else to say here? I think that's really it. It's just about the boundedness, and there's no point in closing off the bounds if it doesn't represent reality. A final point maybe would be, here's a sort of option that that's called a butterfly, where you basically have calls and puts that combine into this shape, or you can have a less harsh shape just before maturity. It's softer, and this is it's hard to describe it in words because you've got sort of you're flipping from like convex to concave to convex to concave again, but it's something you can definitely describe in equations, and machine learning can capture it if you've got these relationships as well. And then the comment about the angles is basically, I read it as a shortcut for seeing like how many options do you need to build up a shape of interest. And if you think about it, like the tan of an angle is basically related to 1, like the number 1. So if you, so the tan of 45 degrees gives you 1. So if you want this to be a 45-degree angle, you just need 1 call. And similar, if whatever angle matches up with 2 calls, you can just use it as a shortcut. If you know the angle that you want, you can sort of map that to the number of calls you'll need at that position to get that shape. And I'll leave it there unless there's any questions or comments. And hand over then to Marcos.
Thanks, Fergal, and thanks, James.
Thank you.
Again, thanks for. I'm learning from you guys, but also I'm comforted to see that these weird results were also found by you.
Good. All good, Marcos?
Yes, just a second, sharing the screen here.
Great.
Okay. Okay. Can you see the slides? Okay.
Yep.
Good. Okay, so let's go over chapter 11, which I'll try not to make as math heavy as before. I think that there's still math to be discussed, but I'd like to start with one of the phrases that I like, which is what we find is not something designed for those who guess right or do nice forecasts. Payoffs are consequences. So we'll discuss that. We'll discuss the Ludwig fallacy and distribution uncertainty and tail clipping. So one of my favorite stories, I think it's from 2008, if I'm not mistaken, by Paul Wilmot. It's about magicians and mathematicians. Suppose that you are in a magic show, and the magic comes at you with the deck of playing cards, and he asks you to take 1 card, then you go and take 1 card, and it's the Ace of Hearts. And he asks you to put inside, put it back in the deck, and you shuffle it, and you give it back to him. And then he goes and draws a card and asks you whether that card is the Ace of Hearts or not. And what is the probability that that is the Ace of Hearts? So the first question is, okay, without the jokers, the deck has 32 cards. 1 in 52. And then you remind yourself, well, but he's a musician, so he knows what he's a trick, he knows, so he's going to show me the ace of cards. And then you go and say, okay, you're either guessing the frequentist kind of behavior that is 1 in 52, or you try to think, okay, it's a trick, it's 100. But the whole point of the article, which I recommend everyone involved in applying probability and mathematics to real life, I encourage you to read, is what is the context? Is the magician setting you up for something else? What is going on beyond that? So you never know the generator. You never know whether the generator is nice or not. In real life, the questions are, the things are mostly outside the box that you kind of think you are. So we need to remind us that before we start trying to find the probabilities of something, do we really know the universe of possible events or not? So with that, let's start and discussing also, when we discuss probability and applications and the applications of probability forecasts, we need to remind that even when we try to find what is a good forecast or whether our forecasts are accurate or not, accuracy is not necessarily the only metric. It's never simple, especially when we discuss unbalanced classes like we do here. And so if you go and define what fairness is in machine learning, there's a whole kind of trade-off between which metrics do I want, what happens if I want to make sure that I have the right representation, that I'm sampling, that I am correcting for the imbalanced sampling or not. And also, when we think about outliers, especially in classification problems, in real life outliers are people. So those XKCD fans probably remember the little Bobby Tables joke. So in fact, if your name is null, or if you have something like that, you're an outlier. You are going to suffer the consequences of something that was done to fit the average or the most frequent cases. So we must be careful about trying to just get accuracy right or forecasting right and think about the consequences of those classifications. Also, every time that we discuss classification problems and we just think about how do we make decisions, we do not have an infinite amount of memory or processing power. So when we look at possible decisions, we do not have a complete probability distribution that is accurate over any period that we want. So we have evolved different encodings for the decision domain. And if something is important, we make it sure that our collective memory remembers it. So we know that we don't need to observe something to know that we have this probability around. Also, we know that decisions accrue over time, and also what we observe today is the result of what happened with our species, not with one particular individual. And therefore, decisions that have an impact on the species have a much bigger impact. So back to the maths. So when we look at chapter 11, when Nassim discusses the conflation between the expected payoff, which is I1. So if we have gx equals x.
Can you make the screen smaller, Marcos, please?
Sorry?
Can you make the screen smaller?
Not
Can you
sure.
zoom?
Okay. Yeah. Okay. So
No. Zoom in. Sorry,
Zoom. Okay.
Oh yeah, no. Sorry. Sorry. It's from my side. Okay.
Okay.
Thanks. Sorry.
Okay. No problem. So okay. So E1 describes the expected payoff. So f of x is a probability distribution. G of x describes the payoff function. Could be 1 in the case of a binary option. It could be x in the case of an option, of a vanilla call option. And I2 describes so the impact of the value of the payoff at the threshold k, and then this is the times the probability of something above k happening. And therefore, we see that when you have something thin-tailed, a Gaussian, which is the shot on the left, we observe that they converge quite quickly. So we see this log-log plot, and for k equals 5, so this is normalized to a variance of 1, so we can see that the convergence is quite fast. But if we take a student T with 3 degrees of freedom, we can see that that difference in log plot is constant, and is still constant over there. So they are quite different. So that is a chart that describes exactly one of the conclusions of the book about the difference and the dangers of conflating the expected payoff with the value at a certain point times the probability of that happening. And that in financial terms is the difference between considering a measure like VAR, which looks like I2, and the expected shortfall, which is closer to I1. So the expected shortfall under Ticktails is much higher than the VAR. And so this is also an illustration about the tail survivor and the approximation of the tail survivor. So again, this is the probability of survival for the student degree 3, and then we can see how the approximation for k raised to the -3 works in terms of the log plot. So this is the fun part. So when Nassim describes the log normal verification, so we define the log normal distribution. So the parameters inside the brackets are the parameters of the normal distribution. And therefore, when we consider this log normal distribution, that log normal distribution has mean x0 and the variance x0 squared times e raised to sigma squared -1. And so there is a mathematical notebook that derives these formulas and calculates the call option using I1 and the binary option using I1 with gx equals 1. So the mathematical notebook will be available on the website as usual. And so we find that those formulas here match those in the book. And we can see the effect of changing sigma for the log normal. And we see that with the small sigma, the call option that pays you X when if the price is above k equals 1 is value about the same as the binary option. It means that basically both are the same. But when you think about the way we have the log normal distribution, there is this drift from the minus sigma squared divided by 2 that makes the mode of the distribution go down, and that decreases the value of the binary option. So it makes the value of the call option bigger because the expected value goes up, but the binary option goes down in value. So beyond those formulas, there is another way of looking into it from something that all of the interested readers here should also be looking at, and that is the ergodicity economics project by O. Peters. So he designed a coin game with multiplicative dynamics in which at every toss, you either gain, let's say, 60% of your wealth, or you lose 40% of your wealth. So that multiplicative dynamics is the same, has the same effect as the log normal returns. So this picture here, so this is a kind of 3D histogram. So we start at the bottom with no coin tosses. So you have your wealth. So your wealth here is represented in log terms. So increasing wealth to the right, decreasing wealth to the left, but this is on log terms. So everything that is minus 10 is really you're bankrupt. You lost all of your wealth. So as the number of tosses increases, there are some really nice throws of heads, 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 heads that will make your wealth go boom. You're going to become the next Mark Zuckerberg. But most of the time, you're not becoming Mark Zuckerberg. You're losing the money because of that drift, and let's say your most frequent value and the mass of the probability distribution goes to the left, means that you're making money. So it's possible to have this average of the ensemble going up, but the mode and the probability mass goes down and you lose money. So that coin game is another way of looking into that log normal and multiplicative dynamics. And this has lots of applications in terms of, let's say, the wealth distribution inside a country and such. So I really suggest that everyone looks at this data. So this chart is the same here. So when we look at the probability of exercise, we see that the probability of exercise goes down as this mass goes to the left of 0, but your expected value goes to the right because this is close to 0 and limited to 0. You're not considering a negative wealth here, but your positive wealth is unbounded, and therefore your expected value tends to go up.
To make a small little comment is that when you have divergence between payoff and probability space, which is how frequently you write, and payoff and expectation space. And the difference between the two is pronounced with distribution that have certain real world characteristic, like the log normal, or even more like the Pareto, the fat tail. Did I summarize right, Marcos?
Yeah.
Yeah, so so there are a lot of oddities that come from that, even without fat tail or without being in a power law class, as with the log normal, with multiplicative process, or actually with every distribution that is one-tailed, because as you increase the variance, you must increase the skewness with it, because there's no mass to the left, so it goes to the right. So we end up having a Dirac delta at the limit to the left, while at the same time, 1 point to the right will make all the money. So in other words, the maximally volatile log normal would give you absolutely no observation outside 0 except for 1, and that one will be infinite.
Yes. So as Nassim pointed out, you don't need a fat tail distribution to see that kind of effect.
For that effect.
Yeah.
And the effect is always present with flat tails.
Yeah. So, okay, so another topic, which is the distributional uncertainty. So again, I'm taking just a particular example. So I'm taking the student T and changing the degrees of freedom. And So from 1 to 10, and then you can see that as you, so if the number of degrees of freedom goes to infinity, becomes normal, and therefore the log of that ratio would tend to 0. But as you become, as your distribution becomes more fat-tailed, that log of the ratio increases, and that means that if you, as you try to think about all the possible distributions that you have, the uncertainty, any uncertainty on the parameters pushes you here, because every time that you don't know how fat-tailed it is, you are just increasing the chances that you come to this domain, and that increases that difference, and that increases the risk that you run if you try to conflate both. It goes back to the hidden mean from the previous presentation.
Okay. So just one little comment to connect it to COVID, for example. It started when people say, well, these guys provided the wrong forecast for COVID. Well, your forecast is always going to be wrong for COVID, almost always going to be wrong for COVID, because think about it, the 99% of the observation, if the mean exists for fat tail distribution, you have something like 99% of the observation falling below the mean. So, of course, you're going to get, most of your forecasts are going to be wrong. And then therefore judging forecasters on this metric makes no sense.
We'll discuss that. There is a slide on that later. So we come back to the matrix. So how do you judge not only forecasts, but how do you judge predictions and actions on the predictions? So the cumulative PNL, when you look at, well, it's the real world. So, but if you're just judging the real world, it's hard to get to the counterfactuals. You just, by looking at someone that, if you look at someone that survived it, you know that you still don't know whether they survived it because of luck, because they have still not died. If you have a strategy that's making money, you're still not sure that is because of skill or because of a good risk management. But it's a better metric than just the probability. So if you, again, we must go back to how long do you need under fat tails to make sure that what you're doing is right and not just by chance. So it's adequate, but we still, if you just focus on the particular realizations of one single individual, it's not enough. So you must look at ensemble of individuals that have similar strategies, and you must look at longer periods of time. But the real danger lies when you look at using just the tally of bets metric, which is just counting whether the people were accurate on predicting something on the binary scale, or predicting something will happen or will not happen without a degree. So there is beyond the DNA adequacies that we're discussing in the chapter as a whole, so there is no time structure, and also depends on how do you define the ranges or the events. There is a better variety of measure of accuracy in predictions, which is the Breyer score, but it's still not very adequate for the very rare or frequent events. So disclaimer here, there's something that we are discussing before the presentation started, which is a theme that goes over what Nassim writes is to look at the distribution of probability distributions, or what is when we look at something like the p-score or the Breyer score, there is always a distribution or an uncertainty. When you look at a particular realization of those metrics, we must always remember that those metrics themselves have probability distributions. So that's something that I probably need to return later to look at the math of the appendix 11.7.4, the Breyer score, and probably work it better. So sorry, I couldn't make it work in terms of looking into that detail here, but it's something that I think that before we end the book, we must come back to.
Yes, I have one comment, one additional comment on this, if you keep the page going, that if you judge people, let's say that people are really expressing things in the right domain, in other full P&L, okay? And psychologists will find that these people overestimate small probabilities. You see, because that's how their methods work, because they're valuing in 2 dimensions something that's 3 dimensions. So of course the truncation of the dimension would cause a bias on that space. And that's the problem with the entire field of psychology. Has, if you take any statement they make on overestimation of small probability, you'll find it's all wrong because of this. Well, that's the first thing. And I didn't advertise it yet, but perhaps Marcos, given that you know the subject, every subject of this book better than I do now, maybe we could co-write something on that effect. And the second point is that you can easily create a category of very, 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 very bad investors. You can create that category who would be excellent at betting in probability space.
Mm-hmm.
You see the idea? And because you find something very skewed and start betting in favor of the likely event, and it will take an infinite amount of time to get the right metric for you. You see the idea?
Yeah.
And then even then you only lost 1 point. You haven't lost much.
Yeah, so it's the same thing when we were discussing before accuracy. So, okay, exactly. If I know something that, I can tell something. Okay, so you're going back to COVID. If we know that mortality is 1% or 2%, just saying that, well, if you get COVID, you won't die. No, it's not informative, because
exactly,
you know
the fact that someone
that you're going to be right. You can, yes, you don't need to get a very good model to tell you that. But the question is, okay, well, it's not informative. You don't get to be rewarded because you make that prediction. That's the whole point. And
exactly. So you make exactly when you make skewed bets, okay, and all you need is lose once to be terminated. So you can't really say. I mean, a lot of people like J.P. Morgan one day said, "Oh, we had not a losing day this year," and sure enough, they got the whale. Yeah. That lost them $6 billion. So you cannot look at in frequency space at anything that has to do with P&L, and this has been repeating for years. People get it who are practitioners implicitly, but they don't necessarily get it explicitly.
Yeah, and I think that and especially when you go to finance, I mean, there is a whole ecosystem that is predicted on people giving advice, but never paying the price for the bad advice. So that
when you give advice, exactly, you have to optimize on frequency space, not on payoff space. Yeah. When you invest, like for example, someone said, "Well, you lost money." I said, "Yeah, I lose money 99% of the time."
Yeah.
okay, I'm an option trader and I trade the tails, and I know it. So long as you know it, you're no surprise for me. I say, okay, they don't understand. And then, of course, a lot of people make money 99% of the time. And I started trading 37 years ago. I don't know any short volatility person who survived, not one. So this idea of super forecasters, we don't have to go into details, is complete bullshit. This is beyond bullshit because it focuses people on the wrong metric, especially when there's no PNL.
Yeah. Yes, and I think that, and going back to one slide that I had before, which is when you try to look at your decision space, and it's the okay, you cannot reward people from being very good discriminators at, let's say, the middle of the distribution, if they, by doing that, they become blind to the tails. So that's the whole point of, you're giving weight to the people who can discriminate between,
Exactly.
that 0.1% move was different from that minus 0.1% move, but they never extrapolate to the 10% moves.
The thing is, this is why I wrote Skin in the Game.
Yeah.
Because basically, when people told me, what's your solution? When I told them fat tail distribution are tail driven. So therefore, the body of distribution become less and less informative as the tails get thicker. And then they said, what's your solution? How should we judge people? I thought about it, said there's no solution except skin in the game. See? Yeah. So you play Russian roulette, you'll get out of the game. If it's your money, that's it. There's no other. Psychologists misinterpreted me or willfully in bad faith by saying, having skin in the game doesn't make you a better forecaster. Not getting the point. In fact, it's a selection process, like Mother Nature. Yeah.
So there is, so if on the presentation that is going to be available, if you click on the link, there is a link to ResearchGate for the paper that Spiros wrote about the M5 accuracy competition paper, in which they describe the improved formula compared with the M4 score. So there is all the detail needed there. So as an example of let's say the tally of bets leading to false predictions, we just need to remember TCM. And also in finance, we must remember that it's still a model. We are still looking at stuff and trying to figure out something, but we need to remind ourselves that the fact that you model that stuff and you start acting on that model changes the model that you're doing. So very good books that you can read about that theme. Derman, and also An Engine, Not a Camera is an excellent book by Donald Mackenzie. And they're both very enlightening about the role that models play in finance. So back to, I think that the main point of the chapter and of everything. So for those who don't know, Zeynep Tufekci, I'm murdering her name, but she's a very good researcher and writer. And she wrote in April about epidemiological models and what is the function of those models. Is, okay, you see that there is the danger of the left tail, prune that tail, which is the same thing that you discuss in commentary 11.7. And you have been tweeting about the last week or two, which is when we do risk management, we are not going to, we don't do risk management by forecasts. You clip a payoff, you change the payoff, and you take off the left tail instead of trying to improve your forecast. So, which is applied to COVID. which is exactly what you're saying. We don't need to be precisely right. This is not a competition that is going to give you awards because you were 5 deaths better than the next person. We just need to know, okay, is this something that the slope is going to increase? Then it's dangerous. Then you need to take stronger measures about it. Or another way of thinking, you don't measure success in epidemiology by nailing the death count. It's by making every death count and saying that.
So in other words, you can't say Russian roulette is 80% favorable, or you can't look at cost-benefit analysis playing Russian roulette, because if you keep playing it by ergodicity in the model you just showed earlier, we're all dead. So you have to just focus on these. And the fattest tail distribution on a planet is we found the alpha is about half for pandemics. So
Yes.
under an alpha of half, there's basically no information of the body distribution. So no model will ever represent what's going on.
Yes, and then again, you don't need to nail every parameter. If you know that you're in that kind of domain, you just say, okay, stop it from arriving there. Stop the slope from increasing a lot. So I mean, I look at what 1 year ago or 1 year and something ago, you would see a lot of people just saying, okay, oh, look at this improvement on the CIR model, or look at this model that is feeding the curve and they're now casting it better or something. I mean, it's useful, yes, but once you realize that that this is going to do this, you're just saying, okay, it's in that class. Every effort now is saying, okay, get out of the, make it sure that it stops before growing too much, because you know what's going to happen. It doesn't matter if it takes 3 months or 3.5 months to get there. So and again, the difference is, again, when we look at the payoffs, and what makes it harder is that on epidemics, and it's different from the kind of exercise of the let's say undergrad students doing a psychology test. Your individual decisions are changing not only the probabilities, but also the payoffs to others. So on epidemiology, you cannot have a doctor saying something. You just go to say, okay, the consequences if you're a healthy adult might be not bad for you, but they're going to be bad to everyone that interacts with you, if the behavior is like that or not. So, yeah.
You know, before thanking everyone and everything, thank you, Marcus. I have one final comment about the super forecaster, is that this chapter was initially written with Tetlock as a chapter with simplified mathematics, with the same points, that we work in payoff space, not in probability space, and the difference between vanilla and binary, as you just showed. And he co-authored it. He visibly didn't understand it. Then he got some funding from the government to do forecasting. So he called me up. He said, "We have funding from the government." No way. I'm not going to take, first of all, public money for anything, and two, I'm not going to. So he completely turned against the idea and kept doing forecasts. This is why I call him a fraud, not any other reason.
Yeah. So yeah, so I went to the super forecasting website today. So it's basically, so there is no, the front page is just okay, these are our customers, become a customer. It's not a paper. So again, proves your point.
Sorry, it's not a what? Sorry.
So it's not. So if you go to the super forecasting website, it's not. Yes. It's not like, okay, these are the research papers, these are our methods, these are our code. This is more like, this, well, it's useful for you. These are our existing customers, become a customer.
Yeah, no, there are some papers behind, but again, they
Yeah.
fail to get the difference between tails and also between payoff and first moment, between zeroth moment and first moment. It's something elementary for any statistician. They fail to get it. And also something worse is that the problem with him is he has is people can get the point. You can observe people may get the point, but then it's not good for them.
Yeah.
So they flip against it and discount it.
Yeah.
And make false claims about their contribution to the paper. You see.
Okay, so before the last slide, so I think it was time for you to, I mean, most of the time people will post pictures of swans and everything, so I think it was time for you to get another animal related to you. So what is that talk? Basically, risk management is not prediction. Even if you get success in forecasting, it won't help you at all with rare events and what the consequences are. And we survive not by improving the forecasting, but by clipping tails. And so here is a picture of a jackal, which is one of the animals that has autotomy, in which he literally clips the tail to survive. So I guess this is a very representative animal in terms of risk management. So I guess that the conclusions here are, I mean, it's something that we don't need a lot of mathematics to understand what is being discussed here. There is a lot of additional mathematics that we can go over in detail, but the conclusions can fit in one slide, and this is something that we should all be able to apply easily. So,
Okay.
thank you again.
Yeah, nice
And
one.
I'll stop sharing. Okay.
Yeah, that was great, Marcos. Thanks a lot for that.
I have a general question if there's a moment. Just observing,
Yes.
like anytime you plot fat tail data sets, you get like the linear behavior, but then it goes a bit crazy in the tail where there's not many points. Is there anything you can take from that?
So when you mean that where exactly?
Like if either with S&P or like I've taken
Okay.
electricity
Yeah,
data.
the log plot. He means the
Like-
log plot.
Yeah.
Yes.
The log plot, because there's a bias, and I think in chapter 3 I showed with Argentina, there's a
Yeah.
bias, is that given that you don't have a lot of data in the tail, by definition, you don't have a lot of points there. So odds are you're not going to get that point that will make things go up in sample. So whenever you estimate an alpha, it tends to be worse, you see?
Right.
That's the idea. It tends to be, the fatter tails.
So it's fatter than you think.
Typically, because all it takes is one. Like if you do the S&P before stock market crash of '87, you would have had a different tail, a much milder tail than what we saw. Sometimes with a pure Pareto distribution, with a pure Pareto, you don't have that problem. It extrapolates beautifully. With something that has a hump in the middle, what we call later on, they call it the Karamata point. So there's a phase below which it's not linear on a log plot, then becomes linear. You see, these distributions sometimes can mess with you, and distributions that have sort of regimes also can mess with you. But the pure Pareto does not, but these mess with you. So you cannot really extrapolate as easily. So you have to consider that the tail may be worse.
Okay. Is it plausible that there's two regimes, so it starts off with one slope and switches?
Exactly. I mean, I have 7 or 8 of those, and I looked at it. Typically, they are already fat-tailed, but your alpha is going to get worse as with time. Typically, as you add observation, your alpha gets lower. more likely to get lower than higher, from my experience of data.
Yeah.
Simply, but with a pure power law, you don't have that effect. With a pure power law, you get the alpha very quickly and extrapolate it.
And I think that on the particular example that we're looking at on the S&P series, so the fact that circuit breakers are introduced after A7, it means that you end up clipping. So there's a lot of returns at very close to 10%. So that's why when you look at the log bridge series and you see that it falls at around 10%, you see those 3 or 4 points quite there. So you end up clipping that. So
maybe that's an explanation to the problem James Sharp mentioned earlier. And that's you remember when we saw the kurtosis is high when not reshuffled?
Yeah.
So if I take, okay, so let me tell you what happened after 87. After the crash, the S&P 500 had no limit, but the bonds had a limit. So the bond market went limit up for 5 days in a row, something like that. 4 days in a row, 5 days in a row. For say it went up 10 points, it would have gone up 10 points in one day had there was no limit. But so if you take weekly volatility, it was higher than daily volatility.
Yeah, so
the limit is 3 points. It goes up 3 points the first day, second day 3 points. So for in 4 days, total 12 points.
Yeah, so
because it's not allowed to show the real number. So there is a shadow number that could probably constitute from people do it with non-synchronous trading or something that shows you that effectively on a daily basis you don't seem to see the whole picture.
Yeah.
But the weekly volatility is higher. You see, weekly volatility should be twice daily volatility. Here it's 4 times.
Yeah, weekly volatility will scale linearly. So it's
Exactly.
because so it happens in Brazil because in Brazil typically the liquid FX markets is on futures and the futures are limited to 6% per day. So it happens of 2-3 days of 6% limit up, 6% limit up, and so on. So that can explain some of the problems in the data.
Yeah, so that explained what James. I was being completely quizzed. I mean, and puzzled that you guys found back my results, right? Which I attributed to my lack of computer skills. But in fact, I'm half joking, not fully joking. But so I realize now that there is an explanation to that fat-tailedness that disappears on the reshuffling.
Yeah, and so this is also a way of thinking about if you are looking into protection or something like that. So we must always remember that some of the markets are now artificially bounded. So you might see that, if you're trading FX, it's much harder to get limits on FX than it is to get limits on markets that, let's say, regulators consider systematically important. So if you're choosing a tail to buy an option or something, that's something that needs to be considered. How are you going to make money on that?
Okay. Are there any more questions? There's one more left. Yeah, we've answered that one, I think. Yep. Okay. All right. So just remains then to thank the panelists. So Marcos, Fergal, Ron, and Nassim. Thanks very much for attending.
Very humbled to see people smarter than me discuss my work.
Okay, excellent. Yeah, so we'll be back hopefully next month in about 4 weeks' time. So if anybody would like to talk about any of these chapters, yeah, please get in contact. Okay.
And if you invite me, I'll be there.
Okay. Do you mean do one of the chapters? Go through.
No.
All right.
I'm not good at it. You guys are better than me.
Okay, excellent. Yeah, we will do. Okay, all right. Thanks, everybody. Cheers. Bye.
Thanks, everyone. Bye-bye.
Thank you.